It's continually repeated that everybody believes that's the best place to put your money, when it is far superior to put money into premiums than it is to put money into house payments. That changed my life. It changed the lives of thousands of my clients over the period of the last 20 years. All of my kids know you don't pay 10 cents extra on your mortgage. You send that to our insurance guy. What do you want to do with your house when you die? I want to give it to my kids. How many kids want their parents' house? Less than 5%.
All right, Harlan, welcome to the show, man. Really appreciate you coming on. And I think we've got a lot of great things that we're going to talk about today, and some very, very valuable information that we're going to be able to share with my listeners and viewers. So I appreciate you.
Well, so good to be here. We can change lives together.
That we can. So I recently got to see you speak at the Life Insurance Summit event this past June. And again, I saw your company, an associate of yours, speak last year, and I was impacted pretty heavily by what he had to share. And just, I knew nothing about the topic of reverse mortgages. And so I had him on the show, and I thought he did a really good job explaining a lot of stuff. Fast forward a year later, you're on the stage. I did get a copy of your book a year ago, read it, gave it to my mom. She read it. My kind of book, not too big, not too small, just right. And again, packed with a ton of valuable information. So saw you on the stage, and again, shared just some information that I think so many people probably aren't privy to. And much like your industry of reverse mortgages, our industry of whole life insurance is very misunderstood. So I wanted to have you on the show and kind of share the value of what the reverse mortgage industry can provide for people, especially if they're working with the right people. So really quickly, tell me a little bit about your backstory and how you got into reverse mortgages, because again, like we were just joking about, I know this is not what you were dreaming of as a young boy, and you said as an adult either. So how did we get here?
Well, great question. I'm at the point where a lot of your listeners are. Reverse mortgages are a bad idea. There's something to stay away from. They screw the old people and hurt the kids, so don't touch them. Break glass in case of fire. Maybe a few people could use it who are maybe really hungry and have no other option. Loan of last resort. That's what I believed. And then I was invited to a seminar about reverse mortgages in Miami in January. And I lived in Wisconsin at the time.
You're like, I'll do it.
So it really was not much of a decision to get out of 30 below weather to someplace warm. And I just was planning on cutting out of the class as soon as possible and taking advantage of the trip down there. And in the first day, I realized that I didn't know what I didn't know. I was really foolishly jumping to conclusions of what it was, and it wasn't what it was. And so I went through the whole 3 days and did not go to the beach. And that changed my life. It changed the lives of thousands of my clients over the period of the last 20 years, because I realized that I was wrong. In fact, I still have it on my business cards. If what you thought about money and mortgages were wrong, when would you want to know? Because there are so many people that completely miss this huge opportunity because they were just like me, where inside of 10 seconds, they dismissed it as something that was bad, not for them, and something they shouldn't even investigate. So I didn't jump right into selling reverse mortgages. I was in regular forward mortgages at the time. And because I was so just shocked by what I realized I didn't know, that I really investigated and talked to a bunch of people, especially in the financial planning world. And we started looking at spreadsheets and software and how does this really work? What if I did one? And 20 years from now, I was 40 at the time, 43 to be exact. And when I started looking at my own personal situation, my parents' situation, my uncle's situation, and people that were already over 62, and started realizing how it fit in, it completely flipped. And then not only did I start selling and planning with reverse mortgages, but I even gave up my forward mortgage business, the traditional mortgage business, hired somebody else to do those loans that require payments, and switched completely over to doing nothing but reverse and working primarily with financial advisors and insurance folks, because insurance professionals and reverse mortgage professionals can accomplish way more together in making, because it's completely related. And by
Mhm.
the way, Sean, I, at the same time, told people to buy term and invest the difference because I didn't know any better because
Yep.
Dave Ramsey said that. And so you wouldn't have liked me 25 years ago. I was just an opinionated young kid who thought I knew what I was talking about, and I didn't. And so I told people buy term and invest the difference and stay away from reverse mortgages. Today, I tell people to get a reverse mortgage as soon as you can and get cash value life insurance and set up permanent life insurance policies as soon as you possibly can, because cash value life insurance, annuities, and reverse mortgages that I have seen over thousands of people personally, including my own self and my own family, are the three most valuable cornerstones that you can have in retirement. So this was a complete transformation, not just revolving reverse mortgages, but revolving my whole understanding of finance, insurance, AUM, annuities, everything together. And the things that are scorned are actually the most important components in a retirement plan.
Mm. You said at the beginning, I didn't know what I didn't know. And I feel like there is so much of that out there and just a lack of knowledge around, I think, all three of those products: cash value, life insurance, annuities, and reverse mortgages. And just like you said, they can be the three foundational cornerstones of a extremely well-built retirement. I'm sure you want to throw some, investments in there and whatnot, but those three things can get you really, really far and make you really, really comfortable.
And I'm living the dream on that, Sean, because I applied it. I'm just a farm kid from Wisconsin and never went to college, so I'm not that smart. But learning from all these people that were way smarter than me, and these PhDs and CFAs and all the researchers that were doing this information and running Monte Carlo simulations, I would just bug them all the time. Well, what about this? What about that? And when they ran numbers, it came out on the side of reverse mortgages and life insurance every time. It wasn't once in a while that it might work in this case. It's amazing how it's just overwhelmingly positive. All the researchers that went into it came up with the same conclusion. It's not that one came up with one idea. And a lady said to me when I was speaking somewhere, I said, "Are you going to come to my keynote at 2:00 today?" And she said, "Oh no, I don't believe in reverse mortgages." And I said, "Well, this is a math-based product. It's not a faith-based product. So you should show up, because if you believe in math, this is a good thing."
Yeah, good thing we're not talking about ghosts, lady.
Exactly.
I love that.
So really, I put it into my own life and started looking at the same time I stopped trying to pay off my house, I started putting money into the cash value of my life policies and mecking out policies, which I didn't even understand what that meant in the beginning. But when I started putting all of that money into those vehicles instead of trying to pay off my house, now today in my 60s, I'm better off, my wife's better off, my kids are better off, my grandkids are better off, because I made the decision not to pay off my house and put more money into better places, specifically the vehicles that you sell and that you help people with. And I just wish more people understood it, because they'd be better off, their kids would be better off. And it wasn't just about retirement. I was better off because I had more cash available when difficult times came along, because even though I was in the mortgage business, can you imagine after 2008, it was very difficult to get money. But how difficult was it to get money from my life insurance policy? Within 5 days, it was in my account. But I was in the mortgage business. I couldn't even get a loan. My line of credit was canceled. I couldn't even get money from my own company, from my own industry, but I could get money from my life insurance. So thank God that I had not paid off my house and had all that money in equity. And instead I had it in cash for the safety of my family and opportunities, quite frankly, that I would not have had if I wouldn't have had more of that cash available. So it was not just a professional change that, I think that this would be a better place for my career. It was a deeply emotional scenario. I've learned how this can help me. I want to help other people. And I want them to see what I did not see and what I specifically spoke out against. I want to help other people, because this is changing my life and my kids' life and eventually my grandkids' life. And of course, my parents' life. I mean, my parents didn't have long-term care insurance, but we used a reverse mortgage at the end to take care of their care. And so this became deeply personal. It wasn't just a career change. It was a mission and a vision of how we could help other people and how I could educate other loan professionals, because that vast majority of financial advisors, insurance professionals, and loan officers do not believe that reverse mortgages are a good idea, and they should only be used in rare cases as a last resort. And so it's not just educating people, it's educating the professionals, Sean.
Yeah. I mean, again, same thing on the AUM side. When people look at, a plan and you're like, oh, well, where's the life insurance here? Why aren't we replacing bonds with whole life? Why aren't we doing all of these things? And again, it's my fiduciary responsibility to make sure that I'm putting your interest first. And it's like, are we really, or are we doing what's right for us? Because at the end of the day, like you said, the numbers don't lie. There are studies out there that this is a great thing. There's studies out there that, hey, putting together whole life and annuities and, asset or, market-based assets, like the combination of these things works great together. But again, it's not something that people are being educated about, because people think investing tends to be dealt with AUM, assets under management. And those two worlds have, for whatever reason, never really mixed. And so it's a job for people like us to be like, hey, don't forget to look at things over here with guarantees on our side. So a lot to talk about here. Let's start for the people that maybe like myself were slightly undereducated. Let's start with the absolute basics of what a reverse mortgage is, because I'm sure, like you just mentioned, there's good stuff that people have heard. I'm sure there's a lot of bad stuff that people have heard. You've been doing this for 20 plus years, so help the listeners understand what a reverse mortgage is in its simplest form.
Well, fortunately, I'm a pretty simple guy, so I had to figure out a simple way to explain this. And that's really where this came from. And it's a chapter in my book as well. I'm not going to go through a whole PowerPoint, but I just want to show these two slides. Everybody who owns a house has three buckets of wealth. Bucket one is that income bucket, where that's a client's bucket, their ability to make money and earn money from a business, get 1099s and commissions or W-2s, whatever. Bucket two is what you manage. That's money that's set aside for the future, money that's not needed today, but will be needed in the future for college or for retirement, for buying a big, some big expenditure in the future. And people only put about 11% into your bucket of their income during a 40-year working time period, but they give us almost 33% of their income on the first of every month. Millions and millions of dollars pour into our office every single first of the month because people are forced to pay off their house over a period of 30 years or 15 years, whatever the case may be. So that's normal and expected, but people don't realize that it's not just rent, it's not just a place to live, it is also an investment. People know that they buy houses because they bought this house, their parents bought a house for $200,000 and now it's worth $800,000 or whatever. So they know that they're investing money. But what happens is they forget about that when they get to be 62 and their income decreases. So they go to their advisor and say, hey, I gave you guys a bunch of money, I'd like some of it back, which is normal and expected. But they don't walk into our office and say, I've given you 33% of my income for the last 30 years, I'd like some of it back. Which is weird because they gave us so much. They had to sacrifice so much. And yet it's cultural, Sean, to just want to pay off a house. And people think that that's like a lifetime crowning achievement. And it's really not. It's not the smartest thing to do. And so when people come to me and say, I paid off my house, it's free and clear, I always say the same thing. I'm sorry to hear that. Not because I'm making fun of them, but I'm sorry to hear that you took all of this money and put it into an illiquid asset that you cannot use, other than live in it, of course, but which is important, but you can't use any of the money, the wealth. And so what we teach people to do is incorporate bucket three. And when you get to retirement, there's only two things that can happen. You have your house paid off, in which point that will give you money back in the form of non-taxable income that you can pull money back out of your house without risk of losing it and without selling the house. The other group of people, which is about 50%, it's pretty much divided half and half, are people like me that either by design or by mistake, we're still making a mortgage payment when we get to be 62. And so a reverse mortgage will either give you income, tax-free income if you have your house paid off, or it will eliminate the requirement to take money out of bucket one or bucket two and pay off your house. So you only have to be down to about 60, 70% of equity. So if you still owe 30 to 40% of the value of your house, then we'll eliminate that payment and make it optional for the rest of your life. And you will pay for the future payments of interest because we're in the business of lending money and collecting interest. People say, well, what's in it for you? Well, we make money by charging interest, whether it is a payment that you pay monthly or whether you pay it at the end of your life or when you move out or whatever the situation is. So we just defer those payments because we know that you have a significant amount of equity in your house and you can take it out. So essentially, to make it really simple, if you're making a mortgage payment, you don't have to when you turn 62 as long as you have enough equity in your house. If you paid off your house, we will give you tax-free distributions, just like a Roth or a life insurance policy that you can pull money out tax-free to live on for the rest of your life. So that's really if you just think of the three buckets and all the research that's been done, the people that have their house completely paid off and have less money in bucket two do not do as well financially and do not leave as much behind. People that don't pay off their house and don't deposit all of that money into bucket three are better off in three ways. They have more cash flow. Obviously, there's another bucket contributing. Number two, they pay less in income taxes. Everybody wants to do that. And number three, they pass on a larger legacy to the next generation. So people think that's very counterintuitive because people think, well, if I don't pay off my house, I might be okay, but I'm going to hurt my kids. But because your taxes are decreased and because you have more money in bucket two, then that makes a dramatic difference. So here's the biggest thing. One of the biggest objections that people have about reverse mortgage. They say, well, I was planning on giving my house to my kids. That's almost like if you ask somebody if the sky is blue. Or what color is the sky? They're just going to say blue. What do you want to do with your house when you die? I want to give it to my kids. How many kids want their parents' house? Less than 5%. So why are we so concerned about giving them a house when they don't want a house? That was different when you were passing on a farm, like where I grew up in Wisconsin, and your parents passed on a farm. That was a business that was passed on. But most kids do not want your house. When you're 90 and they're 60, they have their own house. So what is the best way? The idea is you just really want to just give money to your kids. What is the most efficient way to give money to the next generation? Life insurance. So I've got a whole boatload of life insurance that's worth a lot more than my house. And so when I die, if the kids want my house, I will have more than enough money to pay it off. But if they don't want my house, they can use it for whatever purposes they want, for investing, for sending our grandkids to school, whatever the situation is. So the whole idea is the more money you have in bucket two, the more you leave behind because you can buy life insurance. I have more than $1 million worth of cash value in my life insurance as a direct result because at 43, I stopped trying to pay off my house and instead sent that money to life insurance premiums. This is directly connected, and people don't understand that if you really care about, people have told me, you must not care about your 4 sons because you did a reverse mortgage. No, I care about them more than you do because I put money into life insurance, so they're going to get a bigger death benefit within a month of my death, tax-free, regardless of what my house is worth. And that is the biggest misunderstood scenario, is that the most superior place to put your money is bucket two, not bucket three. Yet everybody wants to put money into bucket three. And you get beat into submission because for 40 years, you're making mortgage payments on the first of the month. Mm-hmm. And you just think that that's the smartest place to put your money. And it's not, but everybody thinks it is. And it's continually repeated that everybody believes that's the best place to put your money when it is far superior to put money into premiums than it is to put money into house payments. That doesn't mean you don't pay your house off. You have to make the minimum house payment, but you don't pay extra. The extra money goes to your insurance professional, not to the house. All of my kids know you don't pay 10 cents extra on your mortgage. You send that to our insurance guy.
Man, that is such a change in what is out there and available for people that they're consuming. I know you mentioned I think you mentioned Dave Ramsey earlier and, that whole thing and just getting people to pay off their houses. And again, I'm not saying like I get some people feel more comfortable about the idea of having a paid off home. But again, that's just because there's a lack of education around what else can be done outside of paying off the home.
You mentioned Dave Ramsey. There's one thing, not a lot of things, but there's one thing in the investment world. He's very wrong on a lot of things. Getting rid of credit cards that are 20% interest or 30% interest, of course. Anybody
Obvious.
should know better than to carry huge balances on credit cards and continue buying things when you've got these great big balances that you can't pay off. So yeah, people should listen to him about not running up numbers on credit cards. But what he doesn't understand about reverse mortgages and life insurance and investing and so on is that I agree that you should not have a mortgage payment going into retirement, but you should have a mortgage that has an optional payment like what I have. So I get a statement every month and it says right on the top, this is not a bill. So I don't have to send in any money, which then I send money to bucket 2 because I don't have to send money to bucket 3 to my house. So he is right that it is not a good idea and it is not that safe to have a mortgage payment going into retirement. But having a mortgage that requires no payment is an entirely different thing. And that is what is properly used. And there's tons of people in their 70s that are still trying to follow Dave Ramsey and pay off their house. And if only they did a reverse mortgage, they'd be a lot safer. There are people that when they lose their husbands, they're going to lose their house because they can't afford to make mortgage payments anymore. So virtually everyone should put this in as part of their plan from the beginning when they're younger. And certainly when they get past 62, 50% of people should not still be making mortgage payments when they go past 62. That's just simply wrong. And that's a mistake that way too many people make is I'm going to pay off my house and they're still doing it. We just ran into somebody 85 this past week, still making a mortgage payment because he said, I'm going to pay this thing off before I die, one way or the other.
Gosh, what a waste. So give me a little background. Explain to me why reverse mortgages have been put into this similar box his whole life, meaning, that they're viewed in such a poor light. Like if, again, both things, once you learn about them, the more you learn, the more you realize how great of a tool and an asset it is. But how did it get to the point where people are just like, ugh, I'm not even taking the time to learn about this?
Well, somebody said to me a while back, where there's smoke, there's fire. There's got to be something bad.
Mm-hmm.
And I said, there is, and there was. There's no question that it can be used incorrectly, which is why I wrote the chapter in my book, Drugs, Sex, and Reverse Mortgages. Drugs can be great. They can save your life, or you can overdose on them and you can die. Sex can obviously be good or it can be evil. So can reverse mortgages. So can, people that use life insurance and sell life insurance the wrong way. There's bad plumbers. There's bad realtors. There's bad car repair people. So there's all kinds of scenarios that things can be bad. It's a proper use. And the problem with reverse mortgages is that for many people, they were not part of an overall plan and they never told their kids about it. So imagine you being an heir and you think you're going to inherit a $500,000 house. And then the bank shows up and says, hey, Sean, your parents took out a reverse mortgage a number of years ago and they owe us $350,000 and you only get $150,000. And you tell all of your friends, the bank took most of my mom and dad's house. I lost my inheritance. And that story has been told thousands of times because the parents never said anything to the kids. And the kids find out about it after mom and dad die, and they are ticked off because the bank stole their inheritance. Now, what's interesting is people never say, my mom and dad passed away, and they used to have an IRA that was worth $500,000. There was only $150,000 left. Those dang IRAs, nobody should have one. But what's the difference? It's exactly the same thing.
No, that's a great analogy.
They use some of their equity to live. And so what's wrong with that? Any different than using some of your IRA to live? So The overall overwhelming issue is that many heirs did not understand and then proliferated and told all of their friends this is a ripoff, and very few people have not heard a story like that. Um, the the second thing is people were never really educated that the goal, because everybody believes, and it's our culture, that you leave a house behind. And many people in my parents' generation, the greatest generation, had left a house to the baby boomers. And so we just kind of feel obligated to leave a house to our kids because that's what mom and dad did. Because when my dad retired in 1981, less than 5% of people owed any money on their house at all. So very different than today when 50% owe money. So everybody inherited their parents' house and just say, well, I should do that for my kids too. And so when that's not talked about, when a house is not left free and clear, it's regarded as a mistake or as a wrong decision, instead of looking at the fact that really life insurance is a better way to leave the inheritance behind. Then there was one other thing. Before 1988, when government reverse mortgages came out, it was the Wild West. And many dishonest people used reverse mortgages to steal houses from the little old ladies. And it was awful because they tricked them in. They gave them a pittance, and then in their 80s, and then they died and they got the whole house. They changed the ownership of the house and just let the little old lady live there, the poor widow. And so because so many widows were taken advantage of and basically lost the ownership of their house, those stories were justifiably terrible. But they weren't reverse mortgages that we do. We don't change ownership of the house. It's safe. It's guaranteed by FHA. Some people say, well, they're just a scam. Well, then they're a government regulated scam that was set up by Ronald Reagan because we can't sell a scam because we are heavily regulated by the Federal Housing Administration. So that was the second issue that they confused. And by the way, those things are still around, Sean. They're called HEIs or HEAs, home equity investments or home equity agreements. They are not mortgages. And there's all kinds of lawsuits out there right now because that's where people sold a portion of their equity, sold a portion of their house to an investment company. And these investment companies are getting returns of 30, 40, 50% per year by stealing equity from people that don't know what they're doing. The third thing, and maybe the biggest, ugliest stain on our industry, was up until 2015, we allowed husbands to take out loans without their wife knowing about it. And a bunch of stupid husbands took out loans and did not tell their wives. And then they died. And then the wives, who were much younger in most cases, got kicked out of their house. You start kicking widows out of their houses and have it on ABC News with Diane Sawyer and USA Today front page and Wall Street Journal front page, you will have a huge reputational problem. And that happened. And then FHA came along and said, this really wasn't our fault, but there's now a lawsuit from AARP and we got to do something about this. So in 2015, the law changed and said, if you have a younger spouse, if you have a spouse, period, you must have her or him on the title. And they must be part of the transaction so they know they're getting a reverse mortgage and that this is something that they're covered with. So when a husband dies, the wife can stay in the house. So my wife was underage, not under 18. She was under 62. Thank you
for clarifying.
Yeah, I want to make sure that's very clear to your listeners or they might not listen.
Somebody's going to take that clip and do something inappropriate with it.
So she was underage at 59, but because I was over 62 and we were married, she was protected. So if I die tomorrow, she can stay in the house until she's 150. So both of us are protected. So because that was not taken care of early in the program and simply an oversight of the rules of the program, that gave us a whole lot of bad press. And then people will come to us and say, don't you think reverse mortgages are awful because some people were hurt? And I said, well, don't you think regular mortgages are awful because more people were hurt in the 2008 crash with forward mortgages than were ever hurt with reverse mortgages? But People remember it for a longer period of time. And I guess throwing a 30-year-old out is not as bad as throwing out a 70-year-old. And so bad news sells much better. So that's why there's legitimate reasons why people have heard bad things about reverse mortgages. And as long as that's something that is fixed going forward in your family, those things have nothing to do with your situation. Yet many people go away from reverse mortgages because they just heard somebody got hurt in the past. So legitimate problems that have been fixed, but it doesn't matter. People believe it's easier to believe the bad stuff.
Man, again, sounds very similar to the insurance space where, there's definitely some black eyes that have been given out here deservingly because of some of the poor choices that have been made in the space. But yeah, to lean on a product, again, like whole life that's been doing what it's been doing for 200 plus years in the US is something that I think a lot of people, again, would find value in once they understand what it is. So talk to me a little bit about if someone should consider reverse mortgage if maybe they didn't need the money.
Yeah. I've never run into anyone, and maybe you have in your financial planning world, that did not take Social Security, even though they were worth millions of dollars. They never say, well, I don't need Social Security, so I'll just let the government keep it.
Just keep it.
Because I don't need it. I'm a big believer in stewarding wealth, whatever that wealth is. And if you're given something, you should spend it properly. You should multiply it properly to be of help to yourself or to other people. You shouldn't waste it. I grew up on a Wisconsin dairy farm with not a lot of money, and we didn't waste food. We didn't waste anything. You picked up pennies and nickels on the sidewalk. And so I hate wasting. Putting all the money in a house, no matter how much money you have, and doing nothing with it is a form of wastefulness, because there are things that can be done with that, not only to help yourself, but to help others inside your family, your second and third generation, or maybe help your causes. We had one client that's worth millions of dollars, and his house was worth $2 million, and he pulled out $1 million out of his house and gave it to his favorite charity, which was accomplishing a ton of things with sex trafficking in Thailand. And so he could have left that money sit, and when he dies 30 years from now, gave his house. But how many people can be helped between now and 30 years from now? So when you don't need money, I've never had somebody turn down and say, well, you can get 5% interest or 4% interest. Which one do you want? People are not going to go to the bank that's paying less on their CD or whatever the case may be. So the biggest thing is, and this was a strange, a number of years ago, somebody told me this and I didn't really believe it. And then I researched it out. The biggest expense in retirement, in the 30 years of retirement, is not healthcare. Everybody thinks it's healthcare. That's usually the last 3-4 years of life where healthcare is the biggest expense. The biggest expense is housing for most people. And for the top 10, 20% of wealthy people, it is taxes. So when people don't need it, that's probably the top 10 to 20%. So they're paying a lot of taxes. The reverse mortgages have a huge benefit in Roth conversions, in tax deductions, depending upon how that's put together. I just did a case study with another life insurance agent in Boston, and we're going to save this client well over $1 million if he just lives for 15 years in taxes. Why give away that money in taxes by bragging about having your house paid off? Because I talked to a lady who said, I'm going to be a hard sell, Harlan, because I love having a paid off free and clear house. And I said, so what you're telling me is that you don't like any kind of mortgages on your house. And she said, no, we had it paid off for 20 years. And I said, well, you do have a $2.2 million IRA and you have a mortgage on that. And she said, no, I don't. We don't have any mortgages. And I said, well, did you ever try to pull it out? There's something called, when you try to sell a house, there's a payoff of a mortgage. Did you ever try to pull $2.2 million out of your account? Wouldn't there be a payoff? And she said, you mean taxes? And I said, yeah. So we don't call it a mortgage, but you have a huge amount of a mortgage that is owed on that 2.2 million. What are you going to do about that? And as we went through the process with her, she realized that if she put a mortgage on her house, that she would pay less on her reverse mortgage over the period of the next 20, 25 years than she would on taxes on that $2.2 million in IRA. And there was a whole life insurance component, all the stuff that you guys do, Roth conversions, everything else. We don't have enough time to go through all the mechanics of that, but we use the money inside the house to pay the taxes for the conversion, so she would have more money in bucket 2 that was tax-free and leave a larger inheritance to her kids. Way over $1 million ahead in 20 to 25 years. So and she doesn't need it. She's got 2.2 million in IRAs and she's got $1 million paid off house. So of course they don't need it, but she wants it because she can save money in taxes. And it's just a more efficient way to handle the wealth. And so if people don't need it, that probably means that they are going to pay a lot in taxes. And we can help them by paying less in taxes. I've never run into anybody. It's kind of funny, this somewhat ethnic, but an Indian guy said to me, do you understand that people from India hate paying interest? We just despise interest payments. I said, well, how do you like paying taxes? Well, that's worse. So he decided to pay interest so he didn't have to pay taxes.
There you go.
So it's really a situation that should be looked at as part of the overall financial plan. What are you doing with the assets that you have? And nobody comes to you, Sean, and says, I don't care about the return. It doesn't really matter. I'm just going to give you $1 million, whatever happens. As long as I get $1 million back, I'm good with it. Nobody would do that. They're saying, well, what is this going to do for me? And what is the results of the return on my investment and my income over time and so on? People should do the same thing with their home equity. They should ask, what is this doing for me? Because they know what their home is doing for them. It's a place to live. But what is the money inside the home doing for you? And that is a mistake that millions of people make, of not expecting a return on their investment that they've dumped 33% of their income for the last 40 years.
So when a client comes in, again, you got to be 62 years old to do this, but when a client comes in to speak with you guys, how are you visually sharing this information with them? How are you kind of walking them through this? Do you have any case studies that you can share or anything that you can kind of...
I do. This was an example of a client that, let me change the name on it here, that we just talked to yesterday. And they've got a house that's probably worth over $1 million, but we just figured it conservatively. And let me pull it up here. We figured it kind of conservatively at $1 million house. And so we show them on a little chart to the right, here's your home value of $1 million. We're not buying your house. You're only 65, so we only give you about 35% of the value over here. So your loan amount that you're eligible for is $338,000.
Okay.
And for ease of figuring here, I'm going to change their mortgage balance to $250,000 because I want to explain the line of credit. So in this situation, not only can we pay off the $250,000 mortgage that will require them to make over $330,000 worth of payments over the next 25 years, because it's a cheap 3% loan that they did 5 years ago, but they still got 25 years left. That means that you got to go till you're 90 and still make payments. So I don't care if the rate is 1%. You're required to be making hundreds of thousands of dollars worth of payments that could go to bucket 2 or needs to be taken out of to deplete bucket 2. They've only got $500,000 in bucket 2. So it's not like they're in great shape at 65 with neither of them working. In fact, they will have to pull money out of their investments to pay off this loan, thus moving money from bucket 2 to bucket 3, which is not a good idea and mathematically will never come out. So in this situation, not only can we pay off their loan and we can pay the closing costs for the loan, I'll come back to that in a minute, but we also give them a line of credit. So what happens is it looks like this after we make the payment. So over here at 65 years old, they have $1 million house. They have the 250 paid off plus the costs of the appraisal, title, mortgage insurance, everything else. The costs are higher for a reverse mortgage than they are for a regular mortgage because of the mortgage insurance. Come back to that in a minute. They still have at this point, they still have over $660,000 worth of equity, and they have a green line of credit that's available for $57,000 that they can pull out tax-free whenever they want. So we've eliminated their payment for the rest of their life. Now, here's where part of the tax thing comes in. We showed these folks how at 69, they're going to have over $100,000 worth of interest built up. And they're going to be able to make a payment from an IRA or some other taxable source, 1099, some sort of income. And then they can take that money back out whenever they want, tax-free, which shows that coming out the next year. When they make a payment on the interest, they're going to get a 1098, including insurance premiums and interest for over for the $100,000 that they paid in. So they're in a better position tax-wise, and they never lost the $100,000 in the first place. Now you can see that this is going to continue to go up, and this is where people get nervous because they look at 75. I'm already going, $584,000. They haven't made $2,000 a month in payments, $24,000 a year for 10 years.
Yeah.
Where did that money go? In bucket two, or money that was not taken out of bucket two. These particular folks, if they continue their lifestyle, will run out of money by the time they're 77. If they die by the time they're 77, they're in great shape. Well, not in great shape, they're dead.
Good plan.
But they're in good shape financially because they won't need any more money if they die. But they're very healthy, and they plan on living a lot of longevity in the family. They're going to live longer than 77, so they don't want to run out of all of their $500,000 in the next 10 years. So, and they will not run out if we convert this over and decrease their tax bill, and so they can use a greater portion of that money to live. And they're going to be in an excellent position going forward from a cash flow perspective because they're not burning up all that $500,000 in the early stages. That's what's really important for anybody to understand, is how that works. And the big thing is people say, well, Harlan, you illustrate everything at 4%. What happens if houses don't go up? What if somebody dies in a year like 2008? Well, if they do, the amount that they owe is capped, but guess what? The line of credit doesn't go away. They can still pull money out of their line of credit, even though it's over and above the value of what the house is. So that's an absolute guarantee because you pay mortgage insurance. You pay 2% mortgage insurance. That's why your closing costs are higher, which is really cheap and a great deal because of the fact that this is money that they never have to pay back. They're safe. And because that insurance was put into place, they never have to worry about what's going to be going forward with that, the worry about the value of the house. And if the value of the house, if we have massive inflation and the house goes up by 6-7%, well, by the time they're in their late 80s, there's $3 million worth of equity left in their $1 million house. The kids will get that. So if things are really good, the money goes to the house, or it goes to the kids. If things are really bad, the kids don't get anything, but they have no bill, and the parents got more money out of the house than it's worth. You don't have to time this thing, Sean. You're going to be okay if the market is great, and if the market is not great. Either way, you are going to be protected in the house, and your kids are going to be in the best position after you pass away because of that guarantee.
Yeah, I remember you sharing a story on one of the podcasts I listened to you on about a gentleman coming to you and mentioning something about his mom being essentially upside down, but still getting checks, and she wasn't cashing them. And you're just like, that's an ideal situation to be in. Like, cash those checks, spend that money. Yeah.
Yes, because it's like an annuity, outliving an annuity.
Yeah.
You just keep getting checks just because you're alive. And the same, that is because it's an insured product. Annuities are sold by insurance companies. It's an insured product. This is an insured product. It's guaranteed to be insured by the Federal Housing Administration. And yes, that takes some money out of your equity, but it guarantees way more, the guarantee is way more valuable than what the cost is of 2%. Your house could fluctuate by 2% in the next month. It's kind of an insignificant number.
Mm-hmm.
Now, by the way, Sean, if This particular client, if we just took let's say that they had $1 million house and it was paid off and they owed nothing, then what would happen, and this kind of goes to your question of what happens when people don't need it. In this situation, what would happen is they would have a line of credit of $307,000 to start, which is guaranteed to go up every single year, even if the value of your house does not go up. By the time they'd be 75, they'd have $641,000 available. They might use this for Roth conversions between 65 and 75. They might use it to help their kids, their grandkids. They might use it to buy a motorhome. They might use it to take care of extra travel, whatever they want to do during that time period. Or if they never use it, by the time they're 85, 86, and they need long-term care, there's $1.5 million available for their long-term care. So if they've not made the sensible scenario of buying long-term care insurance or having long-term care riders in their life insurance, this could take care of some of that if they wouldn't even qualify health-wise. So there's all kinds of different uses. So here's the other 50% that have their house paid off. Does that make sense for them to look at that? Yes, it does, even though they don't quote unquote need the money because it's more efficient and all the money in bucket 2 can grow faster along the way. So that's really, regardless of whether or not you have a lot of money or a little bit of money, or a lot of equity or a little bit of equity, either it makes sense to get rid of the mortgage payment or take a mortgage payment out. And remember, all of these are tax-free. And the third scenario that we show people is, the first question we ask people is, how long are you going to be in this house? There's a lot of people in this age group that want to move or should move.
Really?
And that is because they're in a house that is aging, a house that needs more work, and they're not happy with the house that they're in. And they also, in this particular situation, if there's a mortgage of $250,000, then they've got a payment. Well, what a lot of people don't realize, and they don't want to get rid of this 3% mortgage, we can do a reverse mortgage for purchase. And if these people, let's say, go down to a $500,000 house in a 55 plus community and sell their $1 million house, they don't have to use cash. They can bolster, and these people specifically who only have $500,000, they only give us a down payment of $350,000. We come in with roughly the other $150,000, and they own a house now with no mortgage payment for $500,000, and they have $329,000 left over to bolster their retirement account, whether it be with life insurance, annuities, AUM, whatever you guys feel is the best thing on the other side of the equation. And then we're setting up tax deductions for the rest of their life. This particular client would save about somewhere in the neighborhood of have $500,000 in deductions during their normal life expectancy. So I threw a lot of things out here, but the bottom line is people either are still making a mortgage payment, they're not making a mortgage payment, or they want to move. The reverse mortgage works in any of the three cases. And so it's when people say, well, I don't need the money, or I've got my house paid off, or I'm just about got my house paid off, they think it doesn't apply to them. And it does in a different way.
So
it's kind of like a Swiss Army knife. You don't use, you use a different tool for depending upon what the job is.
Mm-hmm.
And that's really the case for you've got a lot of wealth in your home. What should you do with it? Should you leave it sit there? Should you use it? Should you sell it? Most people never think about that, and they should, because there's a tremendous amount of money there. I talked to an advisor yesterday in California, and he said, I don't need a reverse mortgage, but I'm calling for some of my clients. I said, just a minute, before you say that, how much money do you have in bucket 3? He's got 2 houses, $5.5 million is sitting in bucket 3, doing absolutely nothing. And he's got a fair amount of money. He's got a couple $1 million in bucket 2. But oh my goodness, you're a financial advisor. Do you realize that you could have a whole lot more money in bucket 2 to do more good for yourself, your family, as well as for right now during retirement? The inefficiency of having all that cash in bucket 3 is crazy to me.
Yeah.
I mean, people say, I couldn't. I couldn't sleep at night if I had a big mortgage like you. And I said, well, I couldn't sleep at night if I didn't have a mortgage, because I know there's all that money that could be doing something else, all that equity that could be doing something else.
So that's brought up a couple different questions for me. I think I want to start. I think I heard you mention this before on a previous podcast, but for example, my wife and I are in our mid to late 30s, and we have a rental home that by the time we're in our 60s will obviously be paid off. What is the deal? I know things obviously change over that period of time, but what is the deal with people who have properties that they are not living in that end up getting paid off?
Well, we do a lot of consulting with real estate as real estate experts as to what to do with homes that the investment properties. The best thing is, because somebody else is paying your mortgage, keep a mortgage for if you pay it off, take out more money out of that mortgage because somebody else is paying that mortgage and you can put it to work. Now, some people say, well, that's too risky. And sometimes it is, depending upon what your cash flow is. But if you have plenty of cash flow and you're not worried about that payment and you're not worried about the renters making the payment, you want to have them make the payments for you so you've got more money to put into bucket two. That's what I did personally. I always kept my rental properties at the highest level. And people say, well, yeah, but then I got to keep raising the rent. Well, if the value of your property is going up, you should keep raising the rent, or else you should not have the property. I mean, if you can only get rent for a $400,000 house and it's worth 600, well, then it's really not worth 600. Then you should sell it and let somebody else take the low rent.
Yeah,
because you're being underpaid for what it's worth. So it really should be it should be looked at as a servant to you. That house should be a servant to you. And if there's not enough money coming in to cash flow it, I had a realtor tell me once, well, this would cash flow fine if the client came in with a bigger down payment. And I said, well, that doesn't make sense. Why should they come in with a bigger down payment and get a 0% return on it? It should cash flow at the highest level, or else it doesn't make sense. Real estate developers would never let that happen. But a lot of people that just have their own rental properties, they might have bought it for $200,000. They've never raised rent, and now it's worth $500,000, and they're still getting their little $1,200 a month rent check. So you can't do a reverse mortgage yet. When you're my age, you'll probably be able to do a reverse mortgage on a rental property. It's just not a product that's available yet. But as this gets to be a bigger and bigger industry, more of that's going to be happening.
Makes sense. So a few more questions here. Best time to look at this? Like, what's that? I guess what's the ideal client look like? And then where's that cutoff of like, oh, I don't think this is going to work for this person?
Great question. The best time to look at it is when you buy your first house. So when my son was in his 30s, of course, he's been indoctrinated and brainwashed by me. But when he's driving home from the purchase of his first house, he said, "Hey, Dad, we're the newest homeowners in Eden Prairie, Minnesota. Come over and help us move." And he said, "By the way, Bridget and I read your book, and we know we just started on our reverse mortgage." And I kind of chuckled and said, "Well, it's 30 years yet." And he said, "I know, but we looked at the payments of $2,200 a month, and we know we're going to get a refund of all those payments when we get to be your age." So you should be thinking about that in your financial plan right from the beginning. What are we doing with putting that money in? You have to explain to people with long, detailed ledgers, if you put this much money into a life insurance policy, this is what happens going up to age 120. People should do the same thing with a house. It's an investment. So what are you doing with that investment, and when is it going to come back? So as soon as at 43, when I went to that seminar in Miami, I started planning right then how much I was going to pay on my house. I refinanced from a 15-year to a 30-year and put more money into my life insurance contracts. So that was part of my plan from the beginning, even though I was 20 years away from getting a reverse mortgage. So we help all people that were doing their first purchase, their move-up purchase, whatever it is. How does this fit into the rest of your plan? Because what we do is going to affect what your life insurance professional does. And quite frankly, what the financial advisors do is going to affect what you're going to do with the house. So we should be working together on the same thing.
Wow,
And,
that's a super
and that's
interesting
what
way
a
to look
lot
at
of
that.
people don't do with this investment. They do it with all their other investments, but they don't do it with their house, which it shouldn't be treated any differently. The house should be performing for you. And so in my 40s, I knew that I was going to do a reverse mortgage when I turned 62, which I did the day after my 62nd birthday, because it was part of my plan from the beginning of how that was going to fit in. And that that determined how much money was going into life insurance and how much money was going into my investments.
Okay, I think maybe the last question I have, uh, yeah, I think I'll probably wrap it up here is, well, I guess I wanted to touch on, all right, so say somebody's already able to qualify as far as age goes, they're 62. What is that, in your guys' opinion, what is that percentage of their mortgage that needs to be paid off to say, hey, I think this could work?
You always need to be, if you're young at 62, you have to have 60 to 70% worth of equity, depending upon what the current interest rate is and your age, exact age, and a younger spouse, and so on and so forth. If you're 95, you only need 30% equity.
Makes
So,
sense.
or you can pay it down. There's some people that have a lot of money that will pay it down so they can qualify. Maybe they owe 400,000 and they only qualify for 300, but they've got an extra $100,000 laying around in cash value in their life insurance or some other place that they can pay their balance down, because you're better off paying off 100,000 rather than 400,000 plus interest. So then that's where we work closely hand in hand with you of, if we do this, how does this affect bucket two?
Gotcha. Okay, so my last question is a personal one. How have you kind of built out your current plan? You mentioned at the beginning, cash value, whole life insurance, annuities, your reverse mortgage. Like, tell the people how you've kind of put together this plan to obviously create the ideal quote unquote retirement. You're obviously still working, but I don't need to be doing what I'm doing to be enjoying my life.
Yes. So at 43, I refinanced, as I mentioned, from a 15 to a 30, which freed up $1,500 in cash back then. So immediately I went to my life insurance professional and said, here, I've got an extra $1,500. So I started building up the cash value in my policy immediately, that extra $1,500 a month. And you can imagine how good that was at 43,
Yeah,
putting an
18
extra
grand.
$18,000 a year into a policy 20 years ago when that wasn't as much money as it is now.
Yeah.
That was a pretty good decision. I love my 43-year-old self making that decision when I'm 66.
Yeah.
And so I continued doing that. So when I'd refinance, as the rates were coming down at that point, as I'd get a bigger house, we got a bigger house with the 4 kids. I kept doing that plan all the way through, and I always paid the minimum on my house and then gave the difference to my advisor. And so then that kept building up my cash value, because people say, well, that was risky. What if you would have died? If I would have died, my wife would have got a lot of money.
Mm-hmm.
So she would have been fine financially, because I had a death benefit that a lot of people don't have. Plus, if I didn't die and I was sick, there's a lot of cash value that she had. So she would have never lost the house. But if I would have paid off the house, she would have had to sell the house or refinance the house. And how is she going to refinance the house when she's taking care of 4 kids and I'm disabled?
Yeah.
So I had a bunch of money in cash value and a big death benefit, which would have covered if I died. Well, I didn't die because I'm still here. Now I have a whole bunch more money in cash value and AUM and 2 or 3 annuities that will guaranteed. They're deferred annuities because I don't need the money right now, because I still enjoy what I'm doing and I want to help as many people as possible. But now, as soon as I turned 62, because I'm still working, for the last 4 years, my payment was $3,500 a month. That $3,500 a month is all going to my advisor. I maxed out another policy. So I have that much more death benefit for my kids and my grandkids, and we're that much further ahead.
And you're saying, to be clear for people listening to this, you're saying you're making out the policies because the goal is legacy.
Yes. As well as the maximum performance, depending upon the situation. But, I've got a lot of compassion for the people that are watching this that didn't learn about this in their 40s. And they don't have a lot of money in cash value, and they don't have a lot of money in AUM. But they understand they're better off putting more money in bucket 2. Please. I mean, I was snoring, I guess, a number of years ago, and my wife elbowed me extremely hard. I woke up instantly, and I said, over 62, 50% equity, still making a mortgage payment. And she said, you're sick. All you do is think about reverse mortgages. And I said, that's top of mind. That's what came out right away. If you're over 62 and you have more than 50% equity and you're still making mortgage payments, you don't have to. I want that message to go across to anybody, whether they have a lot of money or they don't have very much. Get more money into bucket 2. If you're really wealthy, don't keep putting money into bucket 3. If you're not very wealthy, don't keep putting money into bucket 3. Bucket 2 is more valuable. It's more flexible. And I go according to a life insurance guy told me a long time ago that you should always run your financial life with luck, liquidity, use, and control, LUC. And money in my life insurance policy is liquid. I can use it and I can control it. The money in my house is liquid. I can use it and I can control it. And unfortunately, there's a whole bunch of people that are smarter than me that have never heard this. And we want to get the news out to them. And that's why I really appreciate being on your podcast.
Definitely. Now, you said something right there at the end that brought up one more thing in my mind. So are they going by, if both people are over the age of 62, are they going by the percentage of the oldest person?
Youngest.
For example, it's by the youngest person. Okay. And
so when my wife was younger, we got less money because she was 3 years younger than me. So it was based off from her age because I'm more likely to go first. And so we're ensuring her ability to stay in the house.
Gotcha. Makes sense. Harlan, this was awesome, man. I think there was a lot of great information in there, and I'm looking forward to sharing this with some of my clients, and again, probably opening their eyes to something that they had never even considered or heard about before.
Well, there's no question, Sean, that a lot of people need to be helped. There's $14 trillion in equity in people's homes, just people over the age of 62. We got to move some of that because it's going to be to their detriment, and they can't live their best life when that's all sitting in an illiquid asset. So we want to change a lot of people's lives. At Movement, we always say that we exist to love and value people, and that includes old people like me. So we want to take care of young people like yourself and building wealth with your homes. And then once you have the wealth, we want to have people being able to use that. But thanks for the opportunity. We can change a lot of lives together.
Of course. And guys, again, if you want to get in contact with Harlan or anybody on his team over at Movement Mortgage, the information will be in the description below. But again, thank you so much, man. Really appreciate it.
You know, Sean, a lot of people are surprised when I actually answer my cell phone. They say, oh, I just thought you were on the podcast. It's 715-207-9991. I'd be happy to talk to you and let you know just that this stuff is really real, and it'd be fun to visit with you. But obviously, you can go on the website too, and whatever is the easiest way to contact us. But I'm not so special that I don't answer my cell phone. That's for sure.
Love it, man. I love it. Well, thank you for sharing your cell phone. Take that, folks. Just reach out to him if you're serious. All right, but. All right, man. Well, again, thank you so much. Hope everybody had a great and safe 4th. And as always, you guys, the information is free, but the knowledge is priceless. We'll catch you on the next one.
Cash flow is key, best believe we'll teach you the way. Invest in your future, there's no time like today. Tune in, rise up, elevate your game. Financial freedom is possible, and it's yours to claim.